Hey guys, welcome to the Untitled Chart Show with your boy Downtown Josh Brown and the one and only JC Parets of All Star Charts. Say hello to the people, JC.
What's up, people?
All right, we're untitled because I feel like Big Trends Monthly didn't really capture the scope of everything JC is bringing to the table each month. So he's doing monthly charts, but he's doing so much more. So we're going to rebrand. You guys can go in the comment section if you have a clever idea for what we should call the Josh and JC show. We're all ears. We'd love to hear it. In the meantime, what we're going to do today is break down the biggest trends happening in the markets right now, the best charts, the worst charts, everything that's going on. This is going to be a very fast and very insightful look at all of the markets that matter to you. Let's get into the first chart that you did, JC. And I like this. There's a lot going on here, but this is really indicative of what's happening in the markets right now.
No doubt about it. I mean, listen, I'm going through my monthly charts, end of the year stuff, and what am I seeing? I'm seeing a shit ton of new all-time highs, like literally all over the place. Dow Jones Industrial Average, Dow Jones Transports, NASDAQ, New York Stock Exchange Composite, indexes all over the world. Like, these are not indicative of downtrends. These are uptrends, right? And then every day I get to work and I'm like, you know, by work, I mean like walk downstairs, right? So I get to work and I start getting asked, JC, when is a correction coming? This is a bubble.
Who's asking that? Who's asking that? Your wife?
Yeah. I wish she was interested. She doesn't give a shit.
Okay.
She's like, hey, I saw that Bitcoin was up today. We still own any? I'm like, oh, not as much. She's like, yeah, nice job. So no, but for real, I'm getting asked all the time, when is this correction coming? And the way I see it, the Dow Jones Industrial Average and transports did nothing for 3 years and just broke out. So if you're already looking for a correction, like, what do you call that? Now here we're looking at financials. This is the XLF. So this is the S&P financial sector that's done nothing for 13 and a half years.
It's amazing.
Zero progress.
It's amazing.
Zero.
Yeah. And all right, so
we can argue, Josh, that this is the most important stock market index in the world. We don't have bull markets in America without financials. And if you ask the Europeans, their indexes are flat for 20 years. So they obviously don't have bull markets without the financials either.
So Berkshire is a couple of dollars away, the B shares, from a record high. Goldman, I think, is there. Those are the two that I looked at most recently. Do all the charts look the same? Like they're about to get above that January 18 high that I think was the top for a lot of these banks? Like, is that what they look like right now?
Well, the broker dealers are certainly indicating that the financials, the higher sector level is going to break out too, because broker dealers and exchanges are already making new highs. But let's keep it real. It's the exchanges that are part of that index that are driving it higher. NASDAQ, CME, ICE, all of those are the big leaders there. So if the broker dealers are making new highs, I can't imagine the XLF is too far behind. Imagine if banks finally break out of a 14-year base to new all-time highs and just now get going.
So I know the why is less important to you, but for market participants watching this, the breakout in broker dealers, the leadership in the exchanges makes perfect sense. You had incredible volatility this year. You had 10 million Americans open brokerage accounts. Like, just this unbelievable moment in time for new traders, new market participants, and tons of activity. So it's not happening in a vacuum when you see these charts break out. Sometimes there's an intuitive reason that explains it. The banks seem to be moving still in concert with what we're seeing in the yield curve, or what we're seeing in spreads in the yield curve. Do you think that those two trends really need each other, or the banks need to see the 2s and 10 spread continue to widen, or they're okay how it is?
No, and I don't buy the whole COVID exchange story either, with all due respect to you. There were leaders before there was any virus, right? That was the leadership group there. Like in healthcare, the medical devices were the leaders. They're still the leaders. We've now gotten rotation into biotech that are now participating, but those robots, those machines have been the leaders for a while. In this case, the exchanges that have been the leaders for a while. That's been the case for years.
Okay. All right. So you like this group though going forward? And
I think if financials break out, think about the implications. Even if you never want to trade a bank for the rest of your life, right? Which is fine. This is information, Josh. If financials are finally breaking out, people are like, JC, when's the correction coming? We haven't even broken out yet. You're already looking for a correction? Come on.
All right, let's do Goldman. So this is a young aristocrat. This is a 180-year-old company. What's going on here?
Well, remember, they're not public that long. So
Right,
they've
sure.
been raising their dividend consistently for 9 consecutive years. And let's remember what a young aristocrat is for us. These are what we think are the future aristocrats, stocks that have raised their dividends for 25 consecutive years. So we want to look for the future stocks of those, the future Coca-Colas and J&Js. Goldman Sachs has raised 9 consecutive years. They're paying almost a 2% dividend. This is a classic young aristocrat breaking out. You said it before even looking at the chart. I don't know if you took a peek beforehand, but yeah, breaking out. We like it. If it's above 250, I like it long. I think this thing has 50% of upside.
I agree, and I like it fundamentally too. I think that when you look at what David Solomon has done beneath the surface here, this Goldman Sachs looks nothing like the one that came public in the late 90s. Huge emphasis on wealth management going forward, asset management, some of the areas where there's a lot more money to be made, and a de-emphasis on proprietary trading. So I think the street likes it. And look, a breakout is a breakout. This is one that I've had my eye on for a couple of weeks. Would you say it's happening now? Like it's already through? Or does it?
If we're above 250, stay long and strong. And I think the XLF and the shitty laggards behind it will catch up. But Goldman's a leader in that space for sure.
Do you trail us with a stop or not necessarily?
Those trailing stops are that's a death wish. You're just begging to get stopped out and whipsawed. You know, those arbitrary trailing stops. I hate that.
Okay, so take the risk.
250, that's the level.
Okay. All right. Let's talk discretionary versus staples. So this is the XLY ETF versus the XLP ETF. You know what's in discretionary is Amazon's the big name there, but a lot of other big consumer name. Is Lulu in that yet?
Home Depot.
Yeah,
I mean it's in there. It's in there somewhere. I don't know if it's a high component, but there's
Disney.
Disney is I believe it's a consumer discretionary. Yeah.
Okay. And then Staples is like supermarket brands. Okay. So
cigarettes, beer, right?
Okay, so this is
Laundry.
like a classical way that people view the markets. They say, are people making purchases they don't need to or not? And that tells you, I think, maybe something about the bullishness of investors, something about maybe the status of the economy. I don't know. What do you get from this technically?
Well, remember, the long-only community can't, these mutual fund managers can't raise cash, right? Their mandate is like 95% allocated long only, so they can't get short either. So the way they outperform their benchmark in a rising market environment is by overweighting discretionary, underweighting staples. The way that they outperform when the market's selling off is that they overweight staples and underweight discretionaries for the reasons that you said before. I like how you put it, whether we're buying things we don't need or not. I like that. That makes perfect sense.
Right. So if you're a long only manager with, I don't know, $50 billion in assets, the way you would express caution would, like, if you can't go to cash, you can go to Kellogg, that kind of thing. You can go to Campbell's. Yeah. Okay.
That's how that works.
Okay.
So there's a reason why the ratio of discretionaries versus staples looks exactly like the S&P 500. And in fact, has been a leading indicator for my entire career. It's just been an awesome, this is, if you're looking for the cheat code, this is the cheat code.
So you just got a new high in this index, in this ratio. Okay.
That's right.
So that's what you want to see.
Well, I don't particularly care, but if you're long equities,
you're an investor, it's what you want to see.
If you're an investor who's long equities and you see deterioration in this ratio, like we got at the beginning of the year, by the way, like we got in 2018, like we got in 2007, like we got in 2015. I mean, we could keep doing this, but the divergences come before turning points in the major markets. I'm showing this chart for two reasons, because consumer staples are breaking out to all-time highs. They're just not outperforming, right? So the fact that we're making new all-time highs in the ratio confirms new highs in the market. And if you look at the next chart, this is just consumer staples alone.
All right, let's go there now.
Breaking out to new highs.
Let's go there now. Now all right, so this is something that I think you've done a good job over the years correcting people on. Just because consumer staples stocks are associated with defensive and people looking for safe plays is not in and of itself a sign that when they go up, it means we're going into a recession. So how people understand this better, I don't know if I'm explaining it well.
Consumer staples going up is consistent with a market environment that stocks are going up, right? Like it's perfectly normal.
Right, they're stocks.
They're
at
stocks.
the end of the day. Okay.
Yeah.
Okay.
However, they're making new relative lows, not just compared to consumer discretionary, but compared to the S&P 500 in general, making new lows, literally closed at a new low yesterday. So staples can go up as long as they're underperforming.
Right. So this looks like if you look at this chart in a vacuum, it looks great. But if you were to overlay this with the S&P, you would see that it's trailing. And again, that's a good thing. That means money managers are not leaning toward bearish trades right now. It could change, but right now. Okay.
For sure.
Got it. Church and Dwight. I was just talking to Eddie Elfenbein on my podcast from Crossing Wall Street. Shout to Eddie. This is one of his new names for 2021, and we both know he didn't come about this name looking at charts. Fundamentally, he loves the stock. So what's going on here technically?
Well, I mean, listen, I don't know anything about fundamentals, but it seems like people have more time on their hands to use condoms. I mean, that's just kind of common sense, I guess. So that's one argument that I've been hearing.
And baking soda.
Sure.
There's a lot of baking.
Right.
And the other thing, there's a lot of both.
But the truth is, every time this thing pulls back, Josh, I mean, look at the chart, look at the data. Every time it pulls back, all it is a buying opportunity.
You could set your watch by it.
Every single time.
What are those, 5% pullbacks?
I mean, they're different magnitudes. Sometimes they're sideways consolidations, but needless to say, 5 consecutive down months for Church and Dwight, to me, that's an opportunity to buy. If Church and Dwight CHD is above 80, I like it long. I think it's got 50% of upside.
I never understood why this was still a standalone company. And it keeps getting bigger, so it's harder to acquire. But like, I never understood why either a big private equity thing or Procter & Gamble or somebody didn't, or Clorox didn't just buy it. Maybe now it's too big.
They wish they did, I'm sure.
They wish they did. Right. Let's do commodities. This is really interesting to me right now. Like, commodities are a really tough way to earn a living, trying to predict the economy based on how they act. But when they're moving in the direction that's intuitive and that you would expect them to, I think people do tend to feel better. So tell us what's happening in price action in the CRB.
The CRB index is back above those 2016 lows, which if you recall in 2016, that's when the market bottomed after that 2015 correction, right? That's when Europe bottomed, Japan bottomed, emerging markets bottomed, interest rates bottomed. A lot happened in 2016. So let's keep that in mind. So we broke down earlier this year below those levels. The market crashed as it should have. And now we are back above those 2016 lows. So to me, the squeeze in commodities is on, and energy has a huge weighting in the CRB index. And that head and shoulders top, that topping pattern, whatever you want to call what oil did over that 4-year period, we are now back above that support, back above that neckline.
Is oil the
squeeze is on?
Is oil the biggest component of CRB?
By far, it's like a third. Okay, energy in general.
Is it markedly different or not really from like the Goldman Sachs Commodity Index or any of the others? Are they all about
the CCI? Remember, the CCI is equally weighted.
Yes.
Right. So this is the CRB, which is more energy weighted. By the way, the CCI looks kind of the same. Also looks strong as well.
Okay. One of our friends, big inflation hawk, Peter Brookvar, was talking this morning about food price, commodity price inflation in the agriculture contracts. Are you seeing something similar there to what you're pointing out in energy, or not quite?
Yep. Commodities in general, except gold. Gold just broke down relative. Yeah. Gold was consolidating relative to the rest of commodities and just broke down relative to both the CRB and the CCI. So the way I see it is the more offensive, the more risk on commodities outperforming, and then gold, the laggard. To me, that screams inflation, emerging markets, weaker dollar, growth, Caterpillar, Honeywell, industrials.
Demand. Yeah. So not just weak dollar, because if it was just weak dollar, then gold would be acting better. This is demand.
Think about how poor gold has acted in a weak dollar environment. That's information.
Well, I think we know $7 billion coming out of gold ETFs and $5 billion going into Grayscale Bitcoin Trust, I think explains a lot of the weakness. You don't have that traditional follow through from ETF buyers in the gold market because there's another shiny thing that's going up a lot more. I mean, I don't think it's more complex than that. I'm not George Soros, but I know how to do basic math.
The gold market's a lot bigger than Bitcoin. I think you need,
so far,
what's the math? Like 20 something Bitcoins to equal one gold. I mean,
so far,
I wouldn't overthink that.
All right, let's talk about I guess this is Intermarket Analysis. You're looking at T-bonds, S&P, gold S&P, staples S&P. What are we looking at here?
This is the answer to JC, what's going to get you bearish? JC, you crazy perma bull buying all-time highs. You nuts or something? The market's going to crash any day now. The Fed, the Trump, the this, the Yellen. I don't know who that Solomon character you mentioned earlier is, but there's always like the market's going to crash
He's a baseball
because of
player.
this.
Okay. Right. Go on. Go on.
So this is the answer to that question, right? What's it going to take? Well, let's put ourselves and think about what the market environment's going to look like if stocks are under pressure. What does that look like? What else is happening around the world? Well, I would argue U.S. Treasury bonds are outperforming stocks, right? You're going to get that defensive flight to safety trade as money's coming out of stocks. It's going to rotate into bonds, particularly on a relative basis.
So you're saying if these downtrends reverse, right now they're near lows. If T-bonds versus S&P were to bottom, you're saying that would potentially be a warning sign that the regime is shifting.
That's absolute. That's one of four. Consumer staples outperforming, as we already mentioned. That's another one. We're making new lows in bonds relative and staples relative. So to be clear, these are the things we're looking for. They haven't happened, right? Gold, you probably get a relative bid. And then finally, Aussie yen flipped upside down. So it looks like the rest of them also making new lows. You're going to get a bid in yen relative to Aussie. So expect these things to rise like they did, as you can see in the chart, in January and February and March, right?
What's great about these ratio charts is that they're easy for anyone to make. You don't need a Bloomberg. You can do this. You can do this on your own, or you can follow JC stuff. And on that note, let's tell people where we want them to go if they want to learn more about All-Star Charts and all of the great stuff that you guys are putting out.
Yeah, no, I appreciate that. Yeah, we talk about these charts all the time, as you can imagine, especially when I get asked so often, which I have been. Go to allstarcharts.com. You can find me on Twitter, StockTwits, Instagram, YouTube, at All-Star Charts. And then I always bring a little gift. So it's a holiday given season. Email candles at allstarcharts.com and use the password charting school. And what Peter's going to do is he's going to give you the first lesson of our 7-lesson course. Get it for free. Nice introduction to technical analysis. I think you'll enjoy it.
Oh, that's very cool. There's a lot of people that are new to the markets and they're just now discovering that there's even a difference between fundamental analysis, technical analysis. They're starting to see charts, but they've not been like trained in any of this, obviously, because they're not full-time traders or whatever. So that's a cool way, I think, for people to get an introduction to how TA works and what it's useful for. So, all right, very cool. We'll put a link to that in the show notes. Guys, thanks for tuning in. I was dead serious about helping us name the show. JC and I will be back next month and every month throughout 2021 talking about the biggest trends that we see happening and the best charts. So stick around, stay tuned, visit allstarcharts.com, check out JC's Chart School, and we will talk very soon.